Welcome back, Portfolio Builder members. We've patiently waited 4 months to make a trade alert, and today we're making some big changes. The SPY is up 15% year to date. We're up 43. I think we peaked out at 52. We've had a lot of crazy things happening in markets. Let's take a look at the high risk portfolio allocation currently. So we dumped our long dollar against the euro position. We've added to the UVXY crash insurance. We've added to treasuries. We've added to our oil inflation hedge. We've added GBTC, and we've got back into the hot tech AI stocks with FNGU. Essentially, we're primarily betting that the market's going to go up, both on treasuries and tech and crypto, but that the main risk against us would be rising oil. And we could end up with the Fed pausing to save the bond market, and we get everything melting up. So that's what we're looking at in terms of asset allocation. The other potential risk is, again, that the Fed keeps tightening, doesn't say they're going to pause, interest rates keep getting out of control until it crashes the whole economy, in which case we'd think UVXY and TMF would still end up winning. So there's a chance TMF could go against us from here, create a massive financial crisis, and then TMF goes skyrocketing up with UVXY, and then you'd see everything on the offensive side going down. That's not my base case. I don't think that's going to happen. But that's what we're looking at. Some critical charts. Interest rates are heavily influenced by the Fed. Assuming the Fed is going to signal no more rate hikes. Remember last meeting they paused, but they signaled, at least half of the governing board signaled that they thought there could be one more rate hike. I'm expecting that to probably disappear in November at the next meeting in about 28 days. And that there's no more rate hikes. And the next speak will be when to end quantitative tightening and when to begin cutting rates. And we're getting a nice dump in oil to help push that narrative through. Okay, here's the TLT, highest volume on record. We bought the dip today. This is mind-boggling. I was surprised it went below 120. I was surprised it went below 100. I think if it goes any lower here, we're going to crash everything. So I do believe essentially there'll be interventions to prevent this from going any further. The main problem is we've had a huge drop in tax receipts while running quantitative tightening, while running up the dollar against foreign countries to fight inflation, while ramping up fiscal spending. So just too much supply and too many forced selling. Of course, if inflation starts to fall, all of this reverses, and there's a massive short squeeze that could potentially drive yields significantly lower here. This crash in the US Treasury bond market now exceeds the great financial crisis. Took twice as long, but the difference was something like a 52% decline versus a 48. Now, again, the speed of the bond crash has been much slower over 2 years. I do believe we are at the end or very near the end for this to start working. Here's a look at the TLT on a 200-day moving average and the RSI getting to extreme levels, typically a buy signal. And again, this could have a sharp push higher if people get short squeezed. And again, it's all going to be relying on inflation data. This is the jaws of death. The treasury market's typically highly correlated to the NASDAQ. So either we're going to see the NASDAQ tank, tax receipts tank, the deficit grow rapidly, and then you get those treasuries finally getting a bid. Or perhaps we get the treasuries just to get a bid on its own, and the NASDAQ can continue to go higher here. We're a big fan of Bitcoin over here and Ethereum. And in the last month, we've seen it finally decoupling from stocks. During the great inflation of the 70s and 80s, we saw gold do this, break its correlation to stocks. And that's when we had stocks and bonds both melt down together. So we're seeing some of that type of action here today in the last month. So if you're a crypto fan, that's what you like to see. You don't want to see Bitcoin being correlated to the NASDAQ. We really are looking at it as a way to preserve wealth in a world where governments spend more money than they make. Next big thing to focus on if you are a crypto fan is the halving cycle. This makes the cost of creating Bitcoin double. And it's happening about every 4 years, and it happens to line up right with presidential elections, which tends to be very bullish for markets. So we've got Q4 typically being a bullish period for stocks. We've got the halving cycle happening in April of next year, and then we've got the election. So there's a lot of reasons to be bullish if you think interest rates are going to start falling from here. And so there's a clear bear market accumulation, bull market pattern. And this is predicting anywhere from $100,000 to $200,000 Bitcoin by around November of 2025, with interest rates falling all the way from today till then. Quarterly returns since 1985, you've got almost triple the potential return in Q4 than the rest of the year, which is what we're heading into. When you're down big in August and September, typically you have a nice return in Q4 of about 7% on average. Meanwhile, another big bullish opportunity for Bitcoin is that the SEC has been sending feedback and holding private meetings with applicants regarding spot Bitcoin ETFs. This will likely come out right before the halving cycle, perhaps in January, February, or March of next year. So they're finally engaging after losing so many different court battles in the past few months. Stanley Druckenmiller says, frankly, if the gold bet works, Bitcoin will probably work better. We have the most bullish month coming up, October, for Bitcoin, although November and December have had some pretty big gains as well. Funny enough, we've often had bubbles pop for Bitcoin in December. And so you can see some of these big drops. It happened in a year and a half ago, and then it happened in 2013 where you had some pretty big declines beginning and then continuing from December into January. But it was after these huge gains leading into it in October, November. S&P 500 is down 33 of the last 50 days and at its 200 moving day average. Quite likely it could bottom out here or near here and then start bouncing back again, so long as interest rates begin to fall. The consumers' credit card spending just dropped precipitously today. We've got so much crazy jobs data. Half the data says it's hot, half the data says it's weak. It does look like different agencies are making up totally different numbers. So probably not good to watch the Friday non-farms payroll relative to the ADP report, because it's just been so all over the place and continues to get revised down after they print hot prints. This is a reminder of where you're at seasonality. And again, the next 50 trading days are typically quite bullish. Now, we're hedging with oil because the US has artificially kept oil prices down by draining its strategic petroleum reserve. And now we're down to 17 days of oil. Now, China has a big reserve, and the main way that we've seen oil price getting jacked up is with Russia and OPEC cutting the supply. So it's not necessarily this huge demand surge driving oil up, although demand has been rising. It's been a mixture of demand rising from the recovery of all the lockdowns, plus the supplies being cut short. Now, if the US is planning to fill this back up leading into the election, we could have some problems with oil and inflation. So they're probably going to let it just sit there low until after the election, would be my best guess. If you're following the Safe Growth portfolio, we've made no changes. Pretty happy with how this sets up for interest rates falling. This whole portfolio is pretty much betting on interest rates falling. That didn't happen this year, so it's greatly underperformed. I still think that's going to happen in the next year, though. So we've got a big bet on treasuries, which we haven't touched. EDC is basically emerging markets. This one will dramatically outperform US markets if interest rates are falling. We've got a huge Bitcoin play with GBTC. And then again, if we're wrong, we're going to expect oil to go back up, potentially break past that $90 to $100 range and cause chaos, in which case we have the huge oil hedge. So no change to Safe Growth. If we do anything next week, I might top up UVXY to 5% like we have in the high risk portfolio. This portfolio again had a huge hit in December of last year and has had a 15% drawdown this year. I'm quite confident without hardly changing this portfolio, it's going to outperform over the next 4 years because we're coming into a situation where interest rates are quite likely to fall for several years. And again, that's highly bullish for all the assets in this portfolio. all eyes are on the 2 versus 10-year rising. So we went negative. This is again looking at past recessions. When you go negative and then rise sharply, it typically leads into recession. So here we are today. And again, we went super negative at -1 basis points. And again, this is from the Fed jacking up interest rates. So it's forcing the front end interest rates to be higher than the long end. And now you can see that has been cut in half, in fact, more by about 60 basis points. So if this breaks positive and starts going up really fast, what it means is your front end is going to be getting cut and the long end is going to stay high. And again, this would also mean that the Fed's probably having to cut interest rates to save the economy from a dramatic crash. At this point, we're not in the crash band camp because the economy does seem quite strong still. Here's your 2-year yield flattening out at 5. Here's TMF down 50% today. We bought the dip for high risk finally after being very, very patient. Here's DXY. Again, it hit 107 a few days ago, and we believe this is about as high as it's going to go because it's causing massive pain for Europe, China, and Japan, essentially forcing them to dump treasuries to buy the dollar to support their currencies, which in turn wrecks their own bond markets. So until the US signals they're going to stop jacking up interest rates and let the dollar fall, it's going to be very hard for the US to fund this massive deficit. Now, there is some interesting things developing with the House Speaker getting ousted yesterday. If you get another hardliner of the supposed MAGA camp, we could see a government shutdown, which would be quite interesting for the economy and would most likely cause yields to fall. Here's a look at the spectrum of interest rates, and we can see it's highest at the very front end and lowest right at the 10-year. So again, if we're going to see a recession, most likely the Fed will have to cut rates towards 0. You see that front end drop, and that's going to make that yield, that 2 versus 10, steepen dramatically. And again, if the market starts doing this, even with the federal funds rate at its current level, then again, maybe a signal that trouble's coming ahead. Here's FNGU, where we bought the dip today, a little bit of a pullback. We made good money on that this year. Sold it, not at the top. We got out a bit early and are back in it, betting that, again, yields are going to fall and the economy is going to be okay heading into the election year. Coinbase, we remained long. Looks like the SEC is going to lose a lot of its battles with Ripple and perhaps with Coinbase and the Grayscale Trust. So if and when that happens, we think Coinbase could skyrocket higher back to new highs from where we saw in July. GBTC has been a great performer this year. It's outperforming Bitcoin, and that's because it used to trade at a 50% discount. And that's because the market believes they will be able to convert into an ETF most likely. So that trading opportunity is not as good as it was earlier this year, but we do think Bitcoin will lead the crypto run up first, followed by Ethereum and then altcoin second, which is why we added that position today. Emerging markets started off really strong this year when it looked like inflation was falling. Then inflation came roaring back, caused yields to rise, and crashed EDC. China has a lot of room to stimulate soon as they believe the Fed's going to pause here. So again, if we think interest rates are going to fall and the dollar is going to fall, EDC should easily outperform the S&P 500. And again, all these companies are valued at much lower valuations than American stocks, which are priced to perfection. And again, all the gains in the US are in about 10 total stocks that are mega tech stocks like NVIDIA. Here's the oil chart. We'll update that. That is the wrong chart I wanted to show today. Here's NRGU. Again, we had a bit of a pullback on this most recently, but this is our hedge that inflation comes roaring back if and when the Fed pivots in November. So if they pivot, we could see oil jump right back really quickly and start to put some pain on the bond market and tech stocks. So this remains a smart hedge, especially when we see that the US needs to refill its strategic petroleum reserve. And we're still in the middle of a war that's potentially heating up. Here's a look at the 30-year bond going way out of its channel. Again, expect this to top out and crash back towards zero over the next 5 to 10 years. If it doesn't, it's gonna be very hard for governments to continue operating how they are currently, which means they'd have to start cutting spending and entitlements. We're not playing gold, but you can see it's just trading flat this year. No big signal there, and the same thing for silver. UVXY has been a huge dud. It's only going to go up if we get a mega crash in an extremely short period of time. They've actually been using the VIX to push the market higher with massive buying and shorting of this position. So we did add to it just in case things are going to break. These interest rates, again, are at obscene levels. Mortgage-backed securities are approaching an average of 8%. The entire real estate market is frozen. And the cost to reservice debt for junk bonds and junk tech companies is going to soon start to become a problem. It just takes a while because they raised so much money at 0% rates and locked it in. They're actually earning a yield on their cash positions now in money markets. KRE, the regional banks, probably potentially at risk with this recent crash in treasuries. So keeping a close eye on that. Again, it's still hanging in there, but not at a good level. S&P 500 has been selling off. It's at its 200-day moving average. I'd suspect it could go a little bit lower and then bounce back to end the year with a rally. Again, assuming interest rates are going to start falling. Same thing for the NASDAQ, except it's acted much stronger. Russell 2000 has been a big loser this year. So no sign in sight of the bulk of American companies actually succeeding in this current environment. The rate of change of the consumer spending growing has just crashed, and that data just came in today. Chinese exports, while remaining soft, are still at healthy levels. US retail sales, again, the data just came in today, just sunk. So we're seeing a lot of signs of essentially calming of inflation. Okay, so that is our presentation for today. I'll go ahead and go back to the trade alert and leave Dean's screen up for a second and take questions. And I'll go back to the current trade alert, so in case anyone has questions on that. Okay, Ashok asked about ETHE against GBTC. So yeah, I like ETHE too. Of course, a lot of you guys have Rebel dividend shares, which has a huge ETHE position. And we also have Bitcoin in Rebel dividends as well. I like all three. I also like Mara. So those are all very similar. GBTC is probably the least volatile, safest bet. In case we crash, it would probably have the least downside risk. It's not going to have the greatest upside risk outside of being the leader of where all the capital flows will go once a Bitcoin ETF is approved. Don says, how does GBTC correlate to Rebel Div? Extremely correlated. Right now, Rebel Dividends has some 5 times leveraged Bitcoin positions that we've been growing rapidly over the last month. Now we use debt from Aave leveraged against Ethereum to build that position. So we love Ethereum in that respect because it has the best ability to borrow money. SQQQ versus UVXY. Yeah, so SQQQ is a directional bet against the NASDAQ. UVXY is a volatility bet. So UVXY is going to only do really well if there's an extreme crash that's rapid and accelerating. And that's what we're worried about with these interest rates so high. So if you went long SQQQ and long FNGU, you're basically just paying fees to both ETF and trying to break even, I guess. When we go long UVXY against FNGU, we're saying, hey, if we get in a major accident and it crashes 20% in a month, then we want a huge payout. That'll be greater than what we've lost on FNGU. Now, if it's a slow pullback, you're not going to get a big payout on UVXY. You're going to just lose money most likely on both positions. So in other words, I would just reduce my exposure to FNGU rather than buy SQQQ with FNGU. Okay, very good, guys. So thank you so much for being so patient for a trade alert. We've really just been waiting for a good entry point, and I think we're really there. Highly confident that we're going to make some good money to close out the year with this current positioning, and we've got the right hedges in place just in case inflation comes roaring back. Which again, I'm highly not believing that's the case. I think we're going to have falling inflation and more of a risk of deflation into next year as these high interest rates finally kick in and start to slow down the economy. Okay, very good. Well, we'll see you guys back next week. Rebel Dividends has its webinar on Tuesday, and we'll have our next Portfolio Builder webinar on Wednesday. And now that we've made changes, we will have a weekly webinar here and keep you updated on each position. So thank you so much, and we'll see you back next week.